Hi everyone. For those of you on the call, we are just going to give everyone a couple of minutes to join and then we'll kick off. Hi everyone. Thank you for joining us today for the latest installment of our webinar series. Today we'll be focusing on investing in the essential with biotechnology, the future of healthcare. And this webinar follows our most recent update on gold, which hopefully a number of you have seen. And please also look out for our upcoming webinar invitation, as we do have some exciting new product launches on the horizon. Now, before we start, I'd just like to highlight our disclaimer. So before making any investment, we do ask, please consider the product disclosure statement, do your own research and speak to a financial professional, really to ensure that this investment product is right for you. And now I'm going to hand over to my colleague, Kanish Chugh. Now he is the co-head of sales here at ETF Securities. But before I pass over to Kanish, we did have a poll question for all our investors listening today, and that is whether you are currently invested in biotechnology. So you should see a poll appearing on your screen now, if everyone can please have a vote in this.
Thank you, Gemma, and thanks for everyone for joining this evening. Just a final bit of housekeeping. We do have in the handout section, you can download a number of different documents that are there. So we do have a product sort of infographic, a 2-page document. It really talks about what biotech is and gives a bit of a summary about what I'll be talking about today. We also have a copy of the presentation if you wanted to download that as well. And we've also got another investment case around biotech that we've written. So we'll be able to, you can download that. A recording of this webinar will be sent out after the webinar concludes as well. And also, if I could ask everyone to stick around at the end, because we do have some survey questions that I'd love to get some insight. It's always good to get viewer feedback, just to make sure that we're constantly refining what, how we present the topics, etc., to make it as relevant for you as possible. Now, interesting to see some of the results coming through, and I'm just going to close that poll now. So it looks like about 40% of respondents have said that they do invest in biotech. They do it via direct stock, which is not uncommon for Australian investors, given the nature that we have to invest in our Australian market. But also about 44% say they don't invest at the moment. So hopefully, we'll be curious to know why that is, and we do have a survey at the end for that. But today's session really wanted to focus on the idea that technology may be typically thought of in terms of computers and communications, but it's really the use of technology in the sphere of biotech that is what is saving lives and changing how we treat diseases. Now, while investing in this area, has an obvious appeal from a social and a moral perspective, but I think it'd be interesting to understand that it can actually be highly lucrative space as a growth investment in a portfolio. So I'll be talking today around what is biotechnology. I think trying to bust some myths around that. Also talking about the evolution that biotech industry has undergone and the future of the industry, and then how you can invest it in biotech. And there's a various number of ways, as already indicated by that poll. Our CURE ETF, and the code being CURE, it tracks the S&P Biotech Select Industry Index, and that gives you a pure exposure to the biotech sector. It falls as part of our wider future present range. Now, for any users of our products, may be aware that this particular range actually encompasses a number of different themes and sectors, and really the idea being we're investing in the current present world, and that being our technology players in our pure tech sector ETF, which is Tech, T-E-C-H. So that's the only pure sector play on technology. We also recently launched a broad-based product in March, which looked at the FANG style stock. So FANG is an acronym that stands for, it basically is the acronym that is used to describe Facebook, Apple, Amazon, Netflix, and Google. But the FANG style stocks they're mega cap stocks, they're highly innovative, they're high quality, and they also include, and that particular ETF was launched in March, so very new. The code is FANG, and so quite apt. But it really gives an equal weight exposure to the FANG stocks plus FANG style names such as Twitter, Tesla, Baidu, Alibaba, Nvidia. And so for us, it was an easy way for an investor to really just capture those names rather than going direct or having to buy a broader exposure that potentially may be more expensive. That ETF is 35 basis points, so one of the cheapest ways to get that concentrated exposure. But encompassing the future present range is also the future, and biotech is one of those future themes that we wanted to talk about, being the future of healthcare, really, and that was the driver of growth in healthcare. But another two themes was robotics and automation and artificial intelligence, and we have an ETF on robo, and that really looks at that disruptive mega trend on that area. And finally, AC/DC rounds out this particular range, and that looks at the thematic of battery technology and lithium. And really, battery tech is something that's really growing as we strive to be a more sustainable planet, and we really try to I guess save the world in some way. And I think the popularity of electric vehicles and the use of battery technology is improving, and that particular ETF covers that theme. But on biotech, and I guess there's a lot of definition, there's a lot of I guess, how do I explain biotech? Where does it fit? Is it healthcare? Is it technology? To break it down, we wanted to provide a very simplistic view, and this is what healthcare encompasses. So healthcare is very broad. It encompasses a lot of different areas. It encompasses biotechnology. Now, biotechnology is specifically referring to technologies that use a biological process. So it's capturing companies that focus on research, development, manufacturing, and or marketing of products based on that biological and genetic information. Different types of biotechnology. It also includes biological drugs, it includes vaccines, and it includes also actual technology in the diagnostics or in the treatment. So that is something that is important. But when you look outside of biotechnology in the whole sector of healthcare, you also have basic pharma, and pharmaceuticals are probably some of the most well-known companies. An example there is Johnson & Johnson. A pharmaceutical company doesn't necessarily mean that it is just doing a pharmaceutical drug. which was based on a chemical process in its development. They could also, like Johnson & Johnson, they have products that focus on treating certain illnesses, but they also sell baby oil. So it can be quite, it's quite a broad term, pharmaceutical. Healthcare services, and that's for Australian investors, it could be something like a Sonic Healthcare, so looking at the radiology, so the x-rays. Healthcare equipment, that's your basic actual equipment. Now, that could be something like a ResMed, who do the sleep apnea machines in Australia, or it starts to go down that path. They're really doing a lot of innovation. ResMed, for example, started working on ventilators as well. And then you also have the life sciences, and that's more down the lines of things like telehealth, for example. Now, within biotechnology, what we've found is it really is the driver of healthcare, and some would say it's the incubator of future growth in healthcare. But I guess with biotechnology, it may sound like a newer industry because of the name and the use of technology, but it actually has a long, rich history. And just trying to show you that here is that biotechnology is constantly evolving. And the reason why the evolution is occurring, and probably the evolution has quickened in pace more recently, is because of the advent of actual technological process has either occurred, so innovation, but also the cost of certain technological processes has to come down. Now, the creation of penicillin is in fact a form of biotechnology. The continued improvements, as I mentioned, of technology over time, it's benefiting this industry. It's enhancing the ability for companies to access and use that biological process, which we may not have been aware of that existed in the past. And an example there was in 2001 when the DNA sequencing was revolutionized, and we had an ability to diagnose certain health concerns in individuals. And then you come to a point where in 2015, where genome editing, which is a relatively new technology, but the cost of genome sequencing has started to fall to the point where biotech companies can use in their process, in their research and development, to identify certain drugs or vaccines to treat patients. I think that's the point here, is what we're seeing is actually a pure evolution in this particular space, and it's only going to continue to grow. Within the modern biotechnology, that we sort of broke it down into a certain, what you could call 6 groups. You have your biological drugs, which I've mentioned. So they're using the biological process in the forms of proteins and peptides. So they work on a different mechanism to standard chemical drugs. You have the use of modern biotechnology to create vaccines. You also have it to use in immunotherapy. Now, immunotherapy, for those that are unaware, is actually the treatment that is designed to harness the ability of the body's immune system to combat an infection or a disease. So it's very commonly used. Immunotherapy drugs are very commonly used by chemotherapy patients, so cancer patients, but also for particular other ailments such as rheumatoid arthritis. You get down this path where you're looking at gene therapy, and this is gene therapy and genetic engineering, is where I was talking about the ability now for us to use the existing technology that has been created, whether it's within healthcare sector or whether it's in other areas, within the actual tech sector. We're actually able to use technology to help produce certain treatments or vaccines to help cure or treat ailments. And the last part is orphan drugs. And I wanted to just mention this because this is, I guess, a somewhat forgotten area. Now, orphan drugs, for those that aren't aware, these are drugs that are not developed by the pharmaceutical industry in general for predominantly economic reasons, but there is a public health need. And actually, when we're looking at the indications of a drug that may also be considered as orphan, it's since a substance that may be used in the treatment of a frequent disease, but may not have been developed or researched for another more rare indication. So what we're seeing is a lot of biotech companies have been able to utilize new technologies or existing technologies and existing cures and treatments, but adapt them to new ailments. And orphan and rare diseases, in particular rare diseases, they don't, they cater, and they're only affecting a very small percentage of the population, which is why a lot of the larger pharma companies may not have thought of a commercial need to go down this path. So it's actually the biotechnology area is really, trying to find a cure for all people. In terms of some of the success stories, so I'm actually going to talk about you know, some of the biotech companies involved in the current, you know, COVID-19 pandemic, talk about the future, but let's look at the past and some of the success stories. And I've got a few examples here. So what you can see there is companies like Biogen, AbbVie, Amgen, or Emergent Solutions. These are some of the biological drugs that have been created by biotech companies and currently sold. You've got a particular drug called Avonex, used by MS patients. It is a biological drug. You know, their sales in financial year 2018 in US dollar terms was close to 2 billion. One of the largest there is a company called AbbVie. Now they created an immunotherapy drug or monoclonal antibody, and the drug is called Humira. Now I was talking about, you know, the immunotherapy drugs in that particular area. You know, whilst primarily used in cancer patients, they were able to adapt this particular treatment and look to use it to treat rheumatoid arthritis patients. And their particular sales for that financial year 2018 was close to 20 billion US dollars. You talk about Neulasta, again, company run by Amgen, looking at chemotherapy care. And then one of the oldest, you know, most well-known vaccines, we talk about smallpox. And it's a little bit confronting, that particular image there. And, you know, the child on the right that doesn't have the sort of has not been affected by smallpox. Now, this vaccine, whilst it was, and a cure was created many decades ago, a company called Emergent Biosolutions has taken patent of that vaccine. They've further refined it, made it more cost efficient. And so whilst their sales are less, they're actually, you know, serving a purpose and in really trying to help society. And that particular vaccine or smallpox exists there from that company Emergent Biosolutions. But I guess coming to, you know, the elephant in the room in being COVID-19, and it's interesting, the pandemic may actually assist in accelerating growth in biotechnology. You know, we've seen biotech companies have been at the forefront in seeking vaccines and cures for COVID-19. And there are currently 11 potential vaccines for COVID-19 that are in clinical evaluation. So that means they're undergoing some form of testing. There are further 128 in what we call preclinical evaluation. Now, I've got a few examples there of not only just pure vaccines, but also companies that are working on either virus detection, and that was something I was referring to earlier. Biotech company doesn't necessarily mean a drug. It could be looking at virus detection or diagnostics. But you've got a company, you've got Moderna, for example. Now, they're specifically working on, and they're a major biotech company. You may have seen them in the news quite recently. They're running clinical testing at the moment. It's the very first company to start human trials, and they're hoping to enter phase 3 trials in July. So this month, with roughly around 30,000 participants. So, you know, you've got companies that are working on trying to find a cure for COVID-19. You've got companies that are trying to find just a therapeutic sort of a treatment for it. And you've got companies like Regeneron looking at trying to create a more efficient way for us to detect the virus. And I was speaking recently with a healthcare analyst, and they mentioned that they're actually not sure if we will find a cure for COVID-19. Obviously, there is always this hope, but it may be that we have to find a treatment for it to be able to get on with our lives. And so with that, we need to make sure we have a treatment that works, hoping that one day we find a cure, but also we have an ability to accurately and quickly detect the virus. And that's where companies like Regeneron. So really the biotech industry is really working on COVID-19. But outside of COVID-19, you know, biotech stocks and biotech industry is not just focused on that area. You know, they're focused on many other areas. And, you know, pre-COVID-19, this would have been the main slide that I will talk about. Unfortunately, because of COVID-19, there's a lot of focus and emphasis placed on that. But this, to me, really is where you're going to find the growth in this industry and where the growth of healthcare is. So majority of FDA, and FDA is the Federal Drug Approval Association for the US, and that's the main, you know, space that a lot of biotech companies look at for when they're doing drug development, and I'll talk about that soon. But a majority of FDA's novel drug pipeline are actually biological drugs, and these are some of the potentially future blockbusters that we may see from a company like Immune Therapeutics, and they're looking at a drug called Palforzia, which is hoping to treat peanut allergy, which if anyone has kids, it's a big concern for when, you know, where as our kids grow up, the allergic reaction that you may have, potentially deadly allergic reaction to peanuts. Or looking at, treating the metastatic triple negative breast cancer from a company called Immunomedics. And again, all of those companies in green are actually companies that exist in the ETF, which I'll talk about towards the end of this webinar. So for us, there is a future beyond COVID-19, and COVID-19 has had positive impacts and there has been a negative impact, and we'll discuss some of those shortly. Now that we understand that some of the success stories that biotech companies have had, the impact or the work that they're doing on COVID-19 and the potential future that they have, let's consider what that process is required when they're going through that drug development stage. So from discovery to commercialization, it's really important to understand that different regulatory events and data from trials produces a significant amount of volatility in the share price. And that is why, for investors, buying directly into some of these biotech companies can be quite risky, which is where the use of a broader exposure, such as an ETF, can help. This particular process is long-winded. And I just to put it into context, it's such a high-risk industry that the high cost for this drug development and the high chance of failure that exists. So, the rewards, whilst for successful trials can be immense, in any given year, 54% of clinical phase 3 trials, and that's pretty much at the final stage that you would have before you get to an FDA approval, typically fail for a range of reasons. The average cost of developing a drug is estimated at more than US 2.1 billion. And just to put it in context, the time it generally takes for trials and approval process can often be 10 years or more. And there's some stats put out that anywhere between 12 to 14% only reach that final approved status. So biotech and healthcare companies then are deriving revenue from approved products. They're using patents. Those patents last 20 years. It's a cost to maintain those patents, because as soon as those patents expire, you have companies, pharmaceutical companies or other biotechnological companies coming in to try and create generic drugs. So for us, the idea is that you could, in theory, invest in a single stock, which may get down to this process of developing a drug and go all the way down and have an FDA approval. And they may only have one drug that they're working on. However, as I've just mentioned, the high percentage of failure rate exists. So they could get to this point, be very successful. You see the share price as they progress through each stage do quite well. But as soon as some policy comes through or government intervention, or they just happen to fail for whatever reason and have to go back to the drawing board, you may see that stock decline. On the other side, you have companies that are running multiple different drugs, working on different areas. But even then, the impact that a drug success from during that discovery process to the commercialization can be massive. And it's a concern when investors consider that single stock risk, so do it with caution. In terms of the healthcare sector as a whole, I mentioned, we're likely to see a greater investment and focus as a result of the COVID-19 pandemic. I think previously anyway, an aging population around the world, there has always been this focus on healthcare. I think the spotlight has just been magnified because of COVID-19. We actually have seen vaccine development specifically for COVID-19 being reduced to just a matter of months. So when a drug has to go from that viral genetic sequence selection, where they were able to identify the actual virus to first human study, very quick turnaround for COVID-19, and there's been a lot of efficiencies created by governments and by companies to try and fast track a lot of that process, compared to say, in SARS, where it's taken close to 20 months. So that's been a positive for COVID-19. Now, the hope is those efficiencies and the lessons learned currently will flow on, and we'll be able to create a more efficient process as to tackle new epidemics or just existing treatments and ailments. Obviously, it has to be within the regulatory standards, but there is a hope that we may have a more efficient process post COVID-19. With healthcare spend, as I mentioned before, COVID-19 had a positive impact in terms of, creating more of a spotlight on this area. They unfortunately had some negative impacts which have impacted it a little bit more in the short term, and that has been around areas such as healthcare spend. Because economies have gone into lockdown, they've had to withdraw general healthcare spend at a broad level. They've obviously increased healthcare spend specifically on COVID-19, but at a broad level it has reduced. So there is an expectation that we'll see a big increase in 2021 and beyond. And just to throw some numbers out there, national health spending growth in the US is expected to average about 5.5%, 5.4% annually through to 2028. So that should reach roughly around 6 trillion a year, and biotechnology will be a beneficiary of that increased investment. Now, with demand of biotech drugs and the demand for treatments and cure and treatments and vaccines, it's only likely to continue. So not just on the basis of that permanent need for treatments and vaccines for existing or yet to be identified diseases, but also actually because we now will have a further ability to improve in the way in which we treat. So, using existing technology or new technology as it's developed, that is what we're actually seeing in the biotech industry. To be able to allow us to be more precise with our drug treatments, or being able to further identify in the genomic space, or lab automation, or regenerative medicine. So if you could just imagine a world where any illness you have can be treated with a drug specifically designed to work with your genes, and therefore hopefully minimizing negative side effects, reducing recovery time. And that, for me, and from when we've looked at this particular area, that is what the future of biotechnology is working towards. Another side of this is, as you get further R&D innovation, the cost of that innovation comes down again, allowing further research and development to occur. So coming on the US, I mentioned the FDA, and I mentioned it being, the gold standard, and the US really being where a lot of biotech companies exist. Our Cure ETF only looks at US listed companies. And why is that? So for us, when we considered it, the US biotech industry, it's valued at nearly $110 billion. Now that's roughly 14 times the size of the Australian biotech industry. So any companies that are seeking to access or distribute their products in the US market, they will then need to go through that FDA evaluation process. And in turn, what occurs, many companies have sought to base themselves there, or partner with existing US biotech companies for an easier access to that process, and also for an easier distribution and marketing to the big, broad US market. Now, when we look at it here in terms of capital markets and money raised, you can see that capital raising in the US reached about 90 billion in 2019. That accounts for 60% of total capital raised globally. 40%, by the way, of that is just for the biopharma sector. So you can tell just by that where the growth is going to come, especially in healthcare.
And Kanish, we have just had a question here. I know you've touched on it slightly, but the question is, how does the biotech industry in the US compare to what we have here in Australia?
Yeah, so as I mentioned, the sectors from a biotech perspective is very large. In the US, it's relatively small here in Australia. If I take that back to healthcare in general, if I looked at the sector breakdown of the total ASX 300, so the top 300 companies by size in Australia that's listed, only 8% would be classified as healthcare. There are 23 companies listed on the ASX 300, which you would classify as healthcare. Now, the largest one, CSL. Most of you may have that in a portfolio, and that is, it's the largest stock, I think, in the market at the moment. In terms of market capitalization, its size is roughly around 130 billion. Of those 23 names, it goes all the way down to Monash IVF, which is 230 million in size. And by the way, Monash IVF, if it was a biotech company, wouldn't even feature in this index because it wouldn't fit the size requirement that this index looks at in terms of the ETF. So, I'll touch on the ETF in a minute, but just based on size, Monash IVF wouldn't even feature. It's too small, essentially. So, you're talking about an area in the US, that is the home of biotech. that is where companies go. And that's why US is still the gold standard, and at least they're a gold standard in something. In terms of where the growth is, and we talk about that, and you've got some figures there that you can talk about and you can read, but the biotech industry, it's predicted to be valued at more than 729 billion by 2025 US, and that's compared to roughly around 300 billion today. Now, it's going to continue to grow. It's driven by a growing global population. It's driven by the need for affordable and effective treatments and vaccines to support treatment in that population. There's an estimated 30 to 35 companies that are expected to go public in 2020. They're expected to raise roughly around 3.5 billion. And I guess with biotech companies as well, they're less impacted by consumer demand shock. The other key point here is we did this analysis, and this is as at April 2020. And if you look at the earnings growth, it remains positive for biotech relative to the S&P 500, which is the broad index that people use for the US market. You're considering on a calendar year perspective, it is still positive. In a market that we've had such volatility and such a bleak outlook, that is something to consider. And a lot of that actual growth is expected to come in Q4 2020. So as lockdowns reduce, I talked about COVID-19 and having a positive and a negative impact. One of the negative impacts, unfortunately, has been a lot of the clinical trials that were working on non-COVID-19 drugs, so pre-COVID-19, had to halt their clinical trial processes because you had the need for hospital beds. Now, as hospitals start to, I guess, deal with, they're basically reset themselves, they've got themselves ready for any, second wave, third wave of COVID-19, those clinical trials can start to occur again. And the FDA also, for a period, just focused on COVID-19 as a priority, and they're now looking, at the other areas that they were working on prior to COVID-19. So, there is an expectation that year on year, from an earnings per share perspective, there is growth to be had towards the end of this year, which is why the opportunity to look at biotech, and it's already been a massive growth incubator for the healthcare sector, but there is an expectation that that may continue.
Now, Kanish, before we jump into this slide, I just wanted to ask the audience another question. And that question is, what's the biggest hurdle you as an investor face when you're considering biotechnology? So again, you should see the poll up on the screen now. If everyone can please have a vote in this.
Yeah, so this will be interesting because, it refers to that question earlier in terms of, we had, quite a large percentage of people say that they haven't invested in biotech. And I'd be curious to know why that is. And, has it been because there hasn't been an investment option? So the Cure ETF that we launched just under 2 years ago now is the only way you can access direct biotech exposure listed on the ASX from an ETF perspective. You can do broad exposures, but pure biotech, you can't. I get a lot of, we get a lot of questions from clients, the lack of knowledge in biotechnology, and I'm hoping today's presentation and some of the collateral and some of the articles that we've written more recently and some of the videos that we've done, hopefully try to bust some of those myths, because I think there's a little bit of a lack of knowledge or, I guess, understanding around biotech. And also Australian investors have somewhat been burnt by biotech stocks in the past. And I think, you're talking about a market and industry that is very small compared to the US, where we're also talking about an ETF that is only looking at top 120 companies by size. So, by having that diversified view, you're hoping to try and take out some of that single stock volatility. So just looking at some of the stats that have come through, and I'll just close the poll now. So nearly 40% said there was a lack of investment options in Australia. Interestingly, talking about the lack of knowledge, 58% said that there was a lack of knowledge on biotechnology, and that's why they may not have invested in this particular space. And you have 35% talking about the volatility in the sector. And I'm not going to shy away from that, and we'll talk about that in a minute, and you'll see it more clearly in this next slide, but there is volatility in single stocks. And there is also some level of volatility on an index level, but it's dramatically reduced because of the diversified view. And that's what we're saying is, how do you invest in biotechnology? So you've got essentially three options. you go down the path of saying, I'm going to take a broad sector ETF, and that is healthcare. Now, within healthcare as a broad ETF, there are one or two options available listed on the Australian Stock Exchange that you can go to. One of those, for example, the crossover, there it includes about 8 stocks, or very limited, 10% exposure to biotech. So very small. So you do get some exposure, but when you're talking about what is driving the growth of healthcare, it's very minimal. You then go down the path of saying, well, I'm going to take some direct stocks. So we talked about the fact that there is some healthcare stocks available in Australia, less so on biotech listed on the ASX. You can, if you wanted to go down and invest directly in the US names like Gilead or like Moderna, or any of the names that are actually featured in the ETF, you can invest. There are certain additional costs involved in investing directly in US markets. The fact that you'd also have to be up during US market hours is another thing. But from a tax perspective, you may also be considered a US investor and therefore have to fill out a W8 tax form. So there's other elements to it in addition to not just cost. And talk about direct stock risk in the next slide. But obviously you could go down the focused ETF path in our Cure ETF, so CURE obviously. The management fee on this ETF is 45 basis points at 0.45%, gives you the purest way to actually take direct exposure to the biotech sector. Now, we've domiciled this ETF in Australia, so for all intents and purposes, you are classified as an Australian investor. No W8 forms are required. It is also currency unhedged, and that is a question that's come through. So there is no hedge, so it's currency unhedged, and all currency exposure is to the US dollar. Now, yes, in theory, you can invest in a biotech ETF listed overseas, but again, the concerns are trading into those US hours, the additional cost to trade international markets, and also a tax component, that you would have to consider, given you may be considered a US investor and you would have to fill out a W8 tax form. So for an Australian listed option, the biotech ETF that we have listed is the best way forward. Now, in terms of, do you want to look at single stocks? And this was the interesting part that we wanted to think about, was biotech stocks are extremely volatile. We've talked about that. What happens if we talked about the year-to-date best performer and how it would have done over the year? So Novavax is the year-to-date best performer. This is to the end of June. They returned, in US dollar terms, by the way, so they returned 1,902.5%. Last year, their percentage return was negative 89.2. Stark differences. And that could be because, and I haven't done my research into specifically Novavax, I'm assuming it could be because they've gone down this path, they've achieved some success in the clinical trials of a particular drug that they were working on. You talk about last year's worst performer, is Novavax again, but last year's best performer, for example, over 1,000% return. Year to date, negative 38.8. So the sort of why we say take an ETF over a single stock is purely for this reason. There is a lot of risk that you would place by trying to identify the winners or losers. And when looking at it in terms of the performance of the Cure ETF against broader healthcare, or even against that S&P 500 index, which is, as I mentioned, the broad US equity market, we look at it in terms of 1 month, 3 month, and 6 month returns. You can see there year to date. So over 6 months, the ETF has returned 19.4%. By the way, broad healthcare, which includes biotech, has returned negative 15.1%. So clearly some stark differences in performance there. The US market, we all know that there was that volatility and there was quite a excessive drop down that we saw in February, March. But again, year to date, still not positive. But the specific biotech sector has prospered during the year. Now, in terms of volatility, that I mentioned before, still more volatile, and we'll talk about how to invest in this particular ETF within a portfolio. So it's really suitable for particular investors that have an appetite for that level of volatility. Now, talking about the ETF and how you can invest in biotech, we launched this ETF in 2018, and it is the ETF Securities S&P Biotech ETF. The code for that is CURE, so C-U-R-E, and as I mentioned, it has a 0.45% management fee per annum. There is no WFN tax forms. We talk about the bias at the moment towards mid and small caps, and it actually bodes well for M&A activity. And what was interesting was there's a lot of M&A activity that occurs within the biotech space, and being biased towards mid and small caps, we actually see that occur, and so you're actually benefiting positively from that activity. Now, the yield at the bottom there is 11%, which is very interesting for a particular, growth or sort of the biotech area. The actual index is less than 1% in terms of its yield. The reason why the product yield is so high is because any capital gains that are accrued by the fund, which occurs when the fund rebalances every quarter, they get paid out on an annual June distribution. So this includes, as at the 30th of June, the distribution that was paid out because of capital gains that were accrued within the fund. So that's why that product yield is so high. With this particular ETF, in terms of structure, we've just had a question come through in terms of are any derivatives being used on the ETF? No. All our ETFs are physically backed. All the equity, the future present range that I talked about, we physically back them. We hold the underlying securities. There are no derivatives being used. Now, in terms of the index methodology, I mentioned before, we are tracking the S&P Biotech Select Index. This particular index, you talk about healthcare, so where does healthcare sit and where does biotechnology sit in perspective? I talked about it at a more simplified level, but this is looking at it from a GICS, so sector classification. So healthcare is divided up into pharmaceuticals, biotech and life sciences, and within that, we are looking at purely biotechnology. And you can see that it's really been the driver for the growth in this particular sector. In terms of the methodology I mentioned, there are currently this ETF, it has 133 stocks within its portfolio. It is equally weighted and it's rebalanced every quarter. Now, why is it rebalanced every quarter? We know that this particular industry and area is fast moving. We've seen that already. And I'll talk to you about the most recent rebalance that occurred within the index. So an ETF tracks an index. That index will rebalance on certain periods, and you will know when those periods are. Each index rebalances at different times. This particular index rebalances every quarter. It is equally weighted, and I talked about the liquidity constraints. So, when they're going through, they're essentially picking out the top 130 companies, 120 companies that fit these liquidity requirements. So the particular companies that are sitting in this portfolio have to adhere and pass these liquidity tests. And that's why I mentioned Monash IVF, for example, whilst sits in our ASX 300, it is just too small to feature in this ETF if it was to be listed, if it was listed in the US, which it's not, obviously. But minimum market capitalization on any stock in this particular ETF is 300 million US. Talking about equal weight, and we get a lot of questions, so the future present range I spoke about, so our tech ETF, our robo, our FANG, ACDC, and CURE, all adopt equal weight approaches. Now, why equal weight? The belief that we have is we are wanting to provide investors an ability to invest in a theme or a sector. We don't profess to say that you should invest in the largest company when you're talking about a thematic or a sector play, because the largest company in that space may not be the winner, especially when you're looking at a thematic view or a sector view. So for us, rather than trying to pick the winner or loser, we're simply adopting a equal weight approach. And that is the approach that we adopt for all those 5 ETFs. It's not the, some of our ETFs, such as our India equity ETF, NDIA, or our European equity ETF, ESTX, they adopt a market cap approach, which is by size, so the largest stocks will get the highest weighting. That approach works for those particular areas, but when we're considering thematics and sectors, we look at saying, well, no, we want to look at the broad sector and the broad theme. There are certain rules around the stock selection process, but from then it's an equal weight approach, which gives you the best approach to consider. It's also diversified as well, so you don't have big swings accordingly, or the ability for the larger stock to impact the portfolio positively or negatively as well. Talking about the rebounds of the portfolio, I mentioned it rebounds every quarter. This is just some of the most recent rebounds that occurred. You can see close to 18 new funds, new stocks, sorry, that were added to the portfolio, and 5 deletions. And there was quite a bit of turnover, and that's just basically as a stock runs, and you can see that here. Apologies. So you can see that there. So, you know, these stocks can have significant rallies, and we talked about why that is. You know, as a particular company is working on a particular drug, they're going through their clinical trial process, so it can rally quite excessively. So the weight of that in the portfolio may move accordingly from the equal weight approach. That's reset every quarter. What was interesting on this chart here, though, because the top 10 is slightly irrelevant given it's 133 names that's equally weighted. So my suggestion to anyone that wants to see all the stocks that are in this portfolio, you can view that on our website. So if you go to the etfsecurities.com.au website, you click on the Biotech product page, there'll be a file or a link called PCF, or Portfolio Construction File. Now that'll be a spreadsheet. It's updated every day, by the way. So you can see the exact holdings within the ETF updated on a daily basis based on weight. So you will know exactly how much exposure you have to, you know, Arrowhead Pharmaceuticals or Novavax or Invitae Corp, for example. When you're looking at the subgroups, as I mentioned, biotech is not just talking about pure drug production and development. You know, we're talking about diagnostic kits, and patient monitoring equipment, drug delivery systems. So there is more to biotech than just pure vaccines. Obviously, that makes up a big part of it, you know, the medical, biomedical gene area, but there is more to it as well.
And Kanish, we've just had a question come through as well, just about how something like Cure would compare to a broad healthcare ETF and whether there'd be much crossover there.
Yes, as I mentioned, you know, there are 2 broad healthcare ETFs that we're aware of that are listed on the ASX. From what we can see when we've done our analysis, it's limited crossover of the biotech. Yes, there is biotech exposure, but they're looking at broad healthcare. So you do get that biotech exposure, but it's of an underweight essentially. And what we would talk about in a few minutes is how to invest it in this particular area of biotechnology. Do you take this as this is the future of healthcare, so therefore this will be my healthcare exposure, or do you use it alongside another healthcare, broad healthcare ETF? And that can be something we'll talk about in a minute, but it is limited, which is why we've seen the disparity in performance actually between these ETFs that we've had. So that our biotech ETF versus some of the broader healthcare ETFs is because of, you know, part of it has been they haven't had that weighting to biotech, and we saw that. If I just scroll up here, you can see that there. If you're taking a broad healthcare index, that's the S&P Global 1200 Healthcare Index, you know, over 1 year, negative 24.4%. The Cure ETF, which is the ETF focusing on biotech, positive 29.4%. So it's close to more than 50% difference between the two there. Now, just in terms of some of the index fundamentals, as I mentioned, it has a weighting towards mid and small cap, and that's quite common when we're looking at this area of biotech. But I would like to just note that, you know, because of our liquidity screen, so as I mentioned, the smallest stock will be 300 million US dollars. There is also other trading screens that are applied in that index methodology. The average market cap of a constituent of a stock in this ETF is 7.7 billion US. So extremely large. And so whilst this ETF that you may see may not be large in size, you know, there's only about 12 to 13 million in assets that we manage at the moment in this ETF. Some of the biotech ETFs, by the way, globally are quite big. There've been a lot more interest and flows in the products overseas, and because they've been around for a lot longer as well. I think there's sort of a better understanding around biotech in the US in particular. But liquidity isn't a concern for us in terms of if we were to have more people want to invest, or on the other side, if they wanted to redeem their investments in the ETF, there is significant liquidity underlying in the underlying constituents and stocks. Now, I just wanted to run through quickly some of the names that feature in this ETF. And if I could just ask, I know some people have already sent through questions, please continue to send them through and we'll try to answer them either during the presentation or at the end. But just a few companies to highlight. So Vertex. Now, Vertex has a strong saturation across the US and it's expected to win European approval for its Trikafta drug, which actually in Q1 2020 had more than just under 900 million of sales. Now, this particular drug, it focuses on the underlying genetic cause of cystic fibrosis. So this is a particular company, for example, that is working on using technology such as gene editing therapy for other particular drugs that they're working on, such as type 1 diabetes cures. They're working in collaboration with a company called CRISPR Therapeutics, another biotech company on gene editing therapy. So this is a company that has a exposure in this ETF, but it's got a commercialized drug whilst working on new drug development as well. Another company is Acceleron Pharma. Now, Acceleron Pharma has a 1% weight in the portfolio. It's in that medical or biomedical gene area. Now, founded nearly 17 years ago, their drug in September, one of its drugs in trials was rejected by the FDA. So last year in September, they had a drug that was rejected. Now, as a result, the stock tanked. Shortly after that, its drug, it's luspatercept, and apologies if I got that wrong, but this is a particular drug, it treats rare blood disorder. Now that was approved. So all of a sudden, we've seen a significant rally in this particular stock because of this area. Is that, as I was talking about before, they may have a number of drugs that are in this development process. They see one drug fail in a particular stage of that clinical trial. They may go back to the drawing board. They may stop working on that particular drug, but then they've got another drug that has succeeded and they've seen a rally in their stock. But for an investor, there's a lot of risk if they were to say, well, I'm going to, invest in this one stock if I want exposure to biotech. Gilead Sciences, it's been at the center of attention for the first half of 2020 because of its work to fight against COVID-19. It's worked on using an existing drug that they created called remdesivir. Now, this drug was created to treat Ebola, but it wasn't very effective for that virus. It, however, has shown promise in treating COVID-19. But while people are fixated on the idea of remdesivir, a potentially bigger story with Gilead is actually to watch it with its other drug, which is filgotinib. Now, this is to treat rheumatoid arthritis. And looking ahead, also, Gilead is trying to work and be a potential game changer with its long-acting HIV, capsid inhibitor, GS6207. Now, this drug, it's only in phase 2 testing right now, but it actually could be the face of the future for Gilead's tremendously, successful HIV franchise. So, we sometimes get fixated on COVID-19, but something like a Gilead, very topical at the moment, very relevant, but they're working on other areas. And finally, with Acceleron Pharmaceuticals, so again, just over about a 1.8% weighting, has a market cap of 25 billion or just under 25 billion. Now, its drug Soliris, it's gained popularity over the years to treat rare diseases. Now, Soliris is actually used to prevent the breakdown of red blood cells in adults. And Soliris is also used to treat a rare chronic blood disease and in adults and children who weigh at least 5 kilograms. So again, we talk about that orphan drug or rare diseases. This is a company that is really focusing on that particular area. Now, where does Cure fit, or where does biotech fit into a portfolio? It has the exposure to international growth through companies, and it's a tactical tilt in the emerging area or the growth area of healthcare. It's more volatile, as we've referenced, and therefore for a particular investor, they have to understand the risks that are concerned with a more volatile exposure and complementing that with their wider portfolio as well. So we did some modeling actually, and we just wanted to show you. So if you complemented the Biotech ETF, or this is just on the index, so this is gross to fees. This is using the S&P Biotechnology Select Index and the S&P 500 Index, which, as I mentioned, was the broad US market. We can see there at this point here, the volatility of just taking the US market and the returns, relatively minimal in terms of if I just went all S&P 500. As you start to slowly move up the curve and you start to allocate towards the Biotech Select Index, in Australian dollar terms, by the way, you can see that your return profile improves. However, your volatility profile increases. And so that is something to be mindful of, that you are taking on more volatility if you are looking to purely go in the biotech area. However, the return obviously profile will improve. So having a complement of two is what the discussion is. So having a core as being the S&P 500 and using your biotech for the healthcare exposure as your satellite. Now, what about those investors who already have a healthcare exposure? Well, again, within your healthcare area, you may want to use the biotech as your satellite. And this is again another profile. But healthcare, as we've spoken about, over a 10-year period, and this is over 10 years, the annualized return on healthcare has been very positive, 16.66%. Biotech, however, has been a clear winner in terms of showing 22.2%, and actually more recently, it's really outperformed healthcare. So again, having a complement within your broader healthcare or your broader US equity exposure to the biotech area is how we see the Cure ETF being used. And just to a lot of people who mentioned how they're taking biotech exposure, they said they're taking direct stocks. Whether that is direct stocks with Australian names or US names, taking the ETF as your core then, and then having the satellite as your single stock. So tactically overweighting to an area by single stocks actually reduces your risk. Still more volatile, obviously, than going just pure US market. But if you are looking at this area, having a biotech as your core, and you are then looking at single stock to allocate accordingly as a satellite, and that is something that we would discuss with a lot of investors, just to reduce that single stock risk that you would have. So finally, obviously, Cure fits into that wider future present range. I guess we can start to, please do send through any questions. And I think someone has just asked, actually, will there be a recording? Yes, there will be a recording of this. It will be sent out after the presentation finishes. But I wanted to point out one thing when I'm looking at this future present range. So, we call it future present because it is really designed for that. It's investing in the present, being your tech exposure. It's existing established technology companies already ingrained in our lives, and the broad-based high quality names of fame, and then your future being biotechnology, robo, and ACDC. The crossover between these ETFs in terms of the underlying stocks is very minimal. If I looked at the tech ETF and the FANG ETF, I believe there is only one or two names that exist that crossover. And I don't believe, and Gemma, correct me if I'm wrong, but I don't think there is any crossover with Cure to any of these other ETFs.
No, Knish, I think that's right. And if there is, it would be only very, very minimal, maybe one or two stocks.
So, for us, when we're talking about growth, the growth range and talking about, investing in disruption, investing in the future, this is how we see that being played out. Happy to answer any questions that come through. So we've had a few questions already. So I'll just quickly point to this slide here. So just before we answer some of these questions, just to say, if you have any further questions, please jump on our website, etfsecurities.com.au. There is a range of information that you can access. Please also subscribe to our monthly newsletter. That's the best way to keep informed. We actually have two very new strategies coming out called the Ultras range. They'll be launching in 2 weeks, and they are a short ETF and a leveraged ETF. So for sophisticated investors that want to use ETFs as a trading tool, there will be ETFs that will be launching in a few weeks' time. So if you want to register your interest for that, please let us know. But any questions you have, if it's product related, don't hesitate to call us on this line, on the sales line. And also if it's a trading query, call that trading line. But just go to the questions now. And do stick around because there is a survey at the end, as I mentioned. So just first question that's come through, is this ETF actively managed or is it automatic? And I guess the best way to consider this is it's an ETF, it's a passive ETF, so it's tracking an index. That index has a rules-based approach. And for those that missed that, the index methodology is those rules, and that is what those rules are. So every quarter, the index applies these rules to create a new portfolio, and that portfolio is what the ETF is tracking. As an ETF provider for this particular, for our passive ETFs, for the ETFs where we track an index, we are not the managers. You know, there are active managers where you're paying higher fees. You know, this fee is 0.45% per annum. So we are not looking to charge active management fees where we have a man or woman sitting there making decisions, a team of analysts, you know, researching. We have put and looked to track an index and to find, and we found the most suitable index to create this exposure to give investors the ability to invest in the biotech sector. Another question has just come through in terms of reinvestment plans for the dividends. So yes, clients can reinvest their dividends. They would just have to notify the share registry, and which is Computershare, just of that you would like to reinvest your dividends, and you would have to do that prior to the distribution dates. If there aren't any other questions, and if there is, we'll try to answer them at a later point in time. Thank you so much for joining us today. As I said, do stick around. Please fill out that survey if you can. It's really useful for us. And hopefully we can speak to you soon.